Good afternoon. Today we're going to be going over savings and payment services. This chapter is kind of an extension of the money management skills chapter, and they're just very, very similar to each other, so there is a lot of overlap between the two. All right, so when we're trying to save money, when we're looking at our spending habits, some of the very common mistakes are overspending. In other words, we spend too much stuff on stuff we don't need, right? Insufficient liquid assets. We get to the end of the month and we're out of cash. Maybe we overspend on food, so we have a whole bunch of food, or maybe we bought our new tires too early, or maybe we prepaid some other expenses that we didn't need to necessarily prepay, and that's left us short of cash and short of a liquid asset to pay current bills. One of the biggest things you can look at to know if you're in trouble is the third one on this slide, using savings or borrowing to pay for current expenses. Current expenses would be food, rent, eating out, stuff like that. If you have no money and you have to sell assets so you can go out to dinner, or you need to put that on a credit card, knowing you do not have the money to pay that credit card off at the end of the month, then that's a problem. What you're doing is you're doing long-term borrowing for something that's going to be consumed in the short term. If you're doing long-term borrowing for, say, like an automobile, it's not a problem to pay a car off over 4 years if you're keeping that car 4 years or longer. Clearly, it's a problem to take 4 years to pay off a really great vacation that you consumed over 1 week. Because then you get a week of enjoyment and 4 years of paying for it. And that tends to get people into very, very bad situations. One of the other things is a lot of people have an awful lot of money stuck in a savings account. $10,000, $15,000, $20,000. Some people have an awful lot more than that. And it makes 1/10 of 1% or 1%. And it's so easy to take that money and slide that money from a savings account over into a certificate of deposit, a CD, a timed account at a bank, and go from 1% to 4%, or from 0.5% to 3%, or something like that. Very easy to do and ends up adding up to an awful lot of money. All right. So what are some of the other things that we need to kind of know about when we're looking at managing our savings? First, we have our liquid savings. This chapter mostly concerns short-term savings. So liquid savings are our savings account. The definition of liquidity, or a liquid account, means that you can go to whatever that institution is or that source of money and cash it in and have very little what is called breakage. So when you look at liquidity, we look at how fast you can get your money and what the quote-unquote breakage is. What kind of discount or penalty do you pay to get that money? So if you looked at a car is a very illiquid asset. If I have a $5,000 car, I can sell it for $5,000, but it might take me 6, 8, 9 weeks to actually get that. If I needed money right now, I might have to discount my $5,000 car all the way down to $3,200 to sell it in a day or two. So I've liquidated my car. I got $3,200. I would have $1,800 in what we would call breakage or fees. And so therefore an automobile would not be illiquid. If I went to my bank and I had $5,000 in a savings bank and I said I want to pull out $5,000, then the bank is basically going to say, do you want that in 20s or 100s? There is no breakage there. Okay, a certificate of deposit. A certificate of deposit is an agreement between you and the bank. So what I'm going to do is slide over here to the board and give you an example of that. All right, banks are in the business to make money. What banks do is they take money from depositors and they pay them interest. That's the cost of money to the bank. Then they take that and they loan it out to you at a higher interest rate. That's then your cost of money. And the bank tries to make the spread between what they're paying for money for deposits and how much they're getting so they can be profitable. So if we look at banks, banks typically have what's called a yield curve. In other words, how much they have to pay for money. So typically, right now, savings rates are really, really low. So I'm going to use some savings rates that, just simple ones for an example. Let's say that you got your checking account, and it pays 1%. And you got savings, pays 2%. And then we're going to get CDs, stand for certificates of deposit. What a certificate of deposit is, it's an agreement between you and your bank that you're going to leave the money there for a certain period of time. If you need your money sooner, you will pay a small penalty. Usually doesn't add up to all that much, 3 months of interest. If it's a very long-term CD, it'll be maybe 6 months worth of interest. So, believe it or not, banks make almost no money off checking accounts. They get a whole bunch of money that comes in. They got people pulling money out at ATMs all over the place. A lot of times the account has $2.12. They have to do all that tracking and send you statements and give you online access. It's very, very expensive. Checking accounts are money-losing accounts for banks. Why do banks have them? Well, the reason they have them, it's kind of like a lost leader type of thing. If banks don't have checking accounts, people will move all their other accounts that are profitable to banks that have checking accounts. So banks can't rely upon this money because your $5,000 gets deposited in there. It's all gone at the end of the month. It's very hard for them to loan money on that. Savings accounts tend to be much more stable. Certainly someone might have $10,000 in a savings account and it drops to 1 because they spend something on it. But more likely than not, if you have $10,000 in your savings account, some people are going to have then a little bit less than $10,000 at the end of the month because they did something. Other people are making current deposits to savings accounts, so it's going to go up. It's much, much more stable money. Because it's much more stable, banks can make plans on what to do with that money. They can loan out much more of that money. Therefore, they give you a higher interest rate to encourage you to move money into savings. A certificate of deposit, also called a time deposit. These could be 3 months, 6 months, 9 months, 1 year, 5 years, 7 years, 10 years, right? They go on pretty far. So when we look at these certificates of deposit, from the bank's perspective, they would much rather have your money locked in for 3 months than sitting in a savings account because they can make more plans for that money. So that money is worth more to them. Banks are competing against other banks for money, and so they will offer a higher interest rate. And they would rather have the money locked up for 6 months than 3 months, so they'll offer more. And the farther and farther we get out, the longer and longer periods of time, the higher the interest rates will be. Because if this bank wants to make a whole bunch of auto loans, and they're going to make auto loans, they're going to make a 4-year auto loan at 8%. Which one of these would they rather have? Checking accounts are incredibly volatile, so the banks don't want to get caught without any money also. The banks took in all the checking deposits, they loan it out to people to buy cars, people come back and they want their checking account money, and the bank doesn't have it because it's out all there in loans. So the bank, in this situation, would very much love to have a whole bunch of 5-year time deposits paying you 5.5% of your money and then loaning that money out at 8%. And the bank then makes the spread between 5.5% and 8%, in this count 2.5%. And they use that 2.5% to pay their overhead, to pay fees, lights, rent, et cetera, et cetera. Okay? So this would be a typical yield curve and why banks are encouraging people to put money in for longer and longer periods of time. Okay, so that was CDs. Banks also offer mutual funds. These mutual funds are basically a person is in charge of an organized fund, and individuals deposit money into that fund. And within that fund, they might buy CDs, gold, stocks, bonds, et cetera, et cetera. We're going to get back into mutual funds much later in the class. Also, when we're thinking of our daily needs for money, we also look at borrowing. So we're going to be borrowing on credit cards, right? Because if I don't have 20 bucks and I'm down at the store and I want to buy $250 at Old Navy, or I want to spend $150 at a restaurant and I don't have it, I borrow money through my credit card. And we get charged an interest rate for that. We also have personal loans. Personal loans tend to be short-term signature loans with no security that carry much higher rates of return. So a lot of us are familiar with personal loans, especially when we're in college, when we get behind on rent or something like that, and we go to our mom and dad or another relative, and they make us a personal loan, which is basically backed by the full faith and credit of our word that we will pay it back. Most personal loans are $2,500 to $5,000. The difference between, say, a personal loan and a car loan is a secured loan that is attached to the car. If you do not pay back that loan, they come and they repossess your automobile. Personal loans typically are not collateralized or tied to some other asset that they could repossess. And because of that, personal loans tend to be higher interest rates. So we want to try to stay away from personal loans. Now, all credit cards aren't bad. We do end up in situations where credit cards are really good. If I have $100 in the bank and I find out that my grandma passed away in Florida and my airline ticket is $350, I want a quick, easy way to borrow money, put it on my credit card, and go to that funeral and then take 3 or 4 months to pay off that credit card. That's what we should do. Also, we might end up in short-term borrowing situations where, maybe you're doing construction and it rained cats and dogs for 2 weeks. And so, therefore, because of all the rain, you got no hours. Or something else happened that was short-term. When we look at borrowing, whether it's credit card advance or personal loans, those should be short-term borrowing in which you have a plan to pay it off way before you borrow the money. If you're going to put $2,000 on a credit card to fix your automobile transmission and you don't have that money, you should already have a plan in place of how you're going to get that paid back. Personal loans and credit card loans are very expensive and very destructive to personal wealth. So there's that balancing act that we have to deal with. All right, what are some of the financial services that we're going to get from banks or basically any other institutions? Well, first off, within savings, we have time deposits. Time deposits are also pretty much considered certificates of deposit. There are slight nuances between the two of them, but for most of us, it's pretty darn irrelevant. We have payment services, right, within our checking accounts, which we can then do demand deposits. A demand deposit means I go to my checking account and I demand the money back out. Banks have to have demand deposits. A demand deposit meaning I go down there, I demand my money, they give it to me right then and there. Savings and loans and credit unions technically do not have demand deposits. If you walk into your credit union and say, I want $5,000 of the $9,000 I have, they can look at you and say, well, today's Tuesday, come back on Thursday and we'll have your money for you. Now, that rarely ever happens within a credit union, especially small dollar amounts. But because they have that option, they actually can keep much less vault cash compared to a bank like Bank of America, which is required to keep a lot more vault cash. For most of us, the differences between banks, credit unions, other not-for-profits, online banking institutions, we don't see too much of that. During an awful lot of deregulation in the last 20 years, blurred most of the lines between institutions. And from day to day, if you walked into a bank or walked into a credit union or walked into another deposit institution, you wouldn't be able to tell the difference. Some of the other financial services that are offered through banks, like insurance, investments, tax assistance, stuff like that, tends not to be a really good deal. Most of the time, you're going to get okay service and pay way too much. You should be buying insurance through an insurance carrier, whether that is AAA, Mercury, Farmers, Fremont, whoever it is. If you happen to be in the bank and they got the insurance person who's sitting there at a desk, it certainly is much more convenient to walk over to that person, sit down, and have them take care of everything and keep everything under one roof. It makes it simple. However, that's going to be expensive. The best advice I could give you on that is to ask someone who you think is pretty smart with money, whether that's your mom or dad, whether that's one of your aunts that runs her own business, or an uncle in the finance industry, and say, hey, I need insurance for a car. I need insurance for my house. I need insurance for this. Who do you use, or who do you suggest I go to? And more likely than not, that person can lead you to a solid recommendation, unless that's someone within your family that just doesn't like you and would rather you went away. That's certainly a possibility too. All right. There's also certain types of accounts that banks have. They're actually kind of cool type accounts. They're called asset management accounts. Asset management accounts are to try to bring an awful lot of different financial products under one master account, and gives you access to that master account and lets you easily move money through those accounts. So I'm going to slide back over to the board, and we're going to go over kind of how an asset management account works. So asset management accounts, how do they work? Asset management accounts are typically operated by small businesses, and certainly by large businesses also, or individuals that have a lot of financial assets. And so we'll kind of have a master account that we're going to open up. And under this master account, I got my checking account. And let's say I've got $65,000 in my checking account, and the interest rate on that is 0.5%. I get really lousy interest rate on my checking account. I've got a savings account, and that savings account, I have $300,000, and I'm making 2%. And then I have a certificate of deposit for 1 month that has $250,000 in it, and I have another CD that just came due, which means I can do anything that I want with it right now, of $200,000. I'm also going to look at the borrowing side that I have. And so I might have a corporate Visa card. And so I've got my Visa card, and it's got a balance of $45,000 on it, and I am paying 12%. I also have an equipment loan of $200,000 that's being paid over 7 years. I'm paying it back over 7 years at, say, 6%. I also have a personal loan or a line of credit, and I've used some of it. And I have used, let's say, $150,000 of my $500,000 line of credit. And that line of credit banks give for working capital, needs go up and down. If I get a huge order at my business, before I get paid, I got to sink a lot of money in. I got to buy raw materials. I have to pay for labor. I have to finish everything, get it inspected. Then I ship it. It's inspected over there, and then I'm paid. So we could very easily end up with large orders, a $500,000-$600,000 order that I've got to pre-front $200,000 worth of labor and raw materials so I can get paid. And let's say that this is costing us 7%. Okay? So what I'm able to do very quickly is to pull up this account, and I can see my cash positions, and I can see my loans, and I can try to make intelligent decisions. So I look, and I got a good amount in my checking account, but I also want to look up when's payday. $65,000 seems like a lot of money in a checking account unless 1 week from now I have to make payroll, and payroll is $200,000. I got $300,000 in savings. Couple things with this. You never know when I might get a fantastic deal on buying new equipment. Or maybe someone is selling copper bar at 45 cents on the dollar because they're going out of business. They're just trying to move that stock, and I want to be able to jump on $100,000, $150,000 worth of that raw material or any raw material incredibly cheaply. I do have my line of credit down here, $150,000 I've used out of $500,000. But I also want to know whether this is guaranteed to stay open. A lot of times banks will open this line of credit and give you the line of credit. But the bank has the right to lower this line of credit. This happens an awful lot when banks get in trouble, banks see the economy going down, and the exact time you might need an awful lot of money to keep your business afloat is the same time that they're cracking down on these. To give you an example, I don't keep a lot of cash. I tend to run all my cash accounts very thin. And most of my assets are in the stock market. They're in stock mutual funds because the rates of return are much better. And against my house, I had a line of credit that was $250,000 that I very, very rarely ever used. I've only used it twice. And so that way, if something goes awry, I know I can write a check to myself for $50,000 if the car gets stolen, if this happens, if I need a new kidney and I got to go buy one over in India or something like that. I have access to that cash. Well, during this last financial turndown, I had a $250,000 line of credit, and I had a zero balance, and one day a letter comes in the mail, and it says, "I'd just like you to be informed, your letter of credit has been reduced from $250,000 to $2,500. And later on, they then cut it again down to $1,500, which is so small it's almost silly. But I didn't have this guaranteed. If you're operating this and you need to rely on this, then you need to make sure that this is guaranteed that they cannot cut that. Typically, you'll pay maybe some fee, like $500 or something like that. But that can be a very good insurance policy. I didn't pay a $300 fee to prevent the bank from cutting that because I just figured I didn't need it. However, if I'd been operating my own business and I had been using that to buy raw materials, to fund labor, and then get paid and pay it off, I could have been in trouble, and I could have been a small business stuck with absolutely no liquidity. And although I'm profitable, I've got good products, I'm making good stuff, I'm out of cash and I can't make payroll. And as soon as you can't make payroll, you're in big trouble. So I'm going to look at this here, and I'm going to see I got about $100,000 worth of payroll coming up, so I want to keep that there. I got my savings account here, $300,000, a couple CDs, one at $250, one that just came due at $200,000. I got a Visa bill here at 12%. I got a long-term equipment loan here at 6%, and I've got my line of credit. So if I don't think I have an awful lot of demands coming to me on this $200,000 CD, what I'll probably do with this is send 40, I can sweep. Asset management accounts are also called sweep accounts because you just you sweep the money this way, you sweep money this way, in and out. So I'll probably take $45,000 of that and sweep it down here to my Visa and pay that off. And what I want to pay off is the highest interest rate. So I can pay that off to 0, leaving me with $155,000. Okay? If I think I got a lot of demands coming up, maybe I think I have to put a new roof on. I've got a whole bunch of raw materials coming due. I want to make sure that I'm backstopped with enough cash. I might take this $155,000 and open up a new CD and keep it liquid so I can access it. Or what I might do here, especially if this is guaranteed that it's not going to get shut down, I'm going to take 150 of this 155 and I'm going to sweep it against my line of credit, paying off this line of credit. I can always go back and write myself a check and re-access this line of credit. And then that would leave me with $5,000. All right? Now my equipment loan here is at 6%, which is far greater than, any other place I'm going to put this $5,000. So maybe I want to take this $5,000 and add a little bit of that to the equipment loan to pay it down. However, if this is a fixed-end loan, I'm not going to be able to re-access this money. That's just going to be gone. Not gone as far as it's paying off the loan, but I won't see any benefit from that cash flow until the last month or so that I don't have to pay 7 years from now. So unless I think I'm really flush with cash, I'm not going to do that. Odds are I'm going to come up here, take $5,000, and I'll just drop that into my checking account because I know later on I've got to come up with $100,000 worth of payroll, and I already know that I'm going to be pulling some money out of savings here to fund payroll. If we get ourselves in trouble later on, or maybe not trouble, we just get a huge order comes in. A huge order comes in, and I need to fund $400,000 worth of raw materials and labor to finish this project to get paid, and then I'm going to get paid $750,000. So it's certainly profitable. And so how are we going to do that? Well, first off, I know I don't want to leave myself too tight here on cash. I got to be able to make payroll. And so maybe I need to come up with $400,000. Maybe I'm only going to take out $100,000 out of savings, and I'm going to go to my line of credit and write a check for $300,000 off my line of credit. So I write $300,000 off my line of credit plus the $100,000 I took in savings. That gets me $400,000 to purchase the raw materials to then start getting that into processing so I can hopefully fill that purchase order. What I don't want to do is leave this at 0 and run myself cash poor and say, I'm going to come in and I'm going to break this CD. I'm going to take $100,000 out of that. I'm going to run my savings to zero, and I'm going to run my checking to zero. That just leaves me cash poor. But you're thinking, well, that's better off because then you don't have to pay 7% on the line of credit, and when payroll comes due, you can fund it off line of credit, especially if this is guaranteed that they're going to keep this $500,000, right? That's all well and good, but what happens if this bank gets in trouble and it gets frozen? Or you've run yourself cash poor and some other unanticipated thing happens, right? We don't want to get ourselves in that situation. Just a bad idea all the way around. So I'm going to want to pull that money off my line of credit to pay for this and leave myself in a much better cash position. Even though, yes, I borrowed $300,000, I am paying 7% interest, and I got $300,000 here, and I'm only getting $3,000. I am losing money, but our bank or our company is in a much safer position using it this way. A lot of this has to do with how incredibly conservative you are and access to other capital, and also who your contracts are with. If you've got contracts with a whole bunch of small companies in an industry that's not doing very well, I'm going to be very, very conservative. If we're coming up to Christmas time and all my POs and stuff that I'm shipping are going to Home Depot and Lowe's and other large companies, Macy's, that tend to pay their bills all the time, then maybe I can be more aggressive because I know I'm going to get paid. Okay, so that's an asset management or a sweep account. Okay, a few more things to touch on before we close out this chapter. One is dealing with interest rates and changes in interest rates, which dovetail nicely into the risk that we just went over of an asset management account and how to borrow money and how to not to have yourself caught short with zero cash. If you think interest rates are going up, in other words, I think mortgage rates are going up, then what I want to do is I want to lock in my interest rates now. I want to get 30-year fixed mortgage rates. 15 years if I think it can be paid off in 15 years. The last thing I want to do if interest rates are on their way up is to get an adjustable mortgage so that as interest rates go up, my interest rate goes up and up and up. I would much, much rather lock it in now. If I thought interest rates were falling, in other words, interest rates are at near highs, I don't want to lock myself into a 30-year loan or a 15-year loan if I think interest rates are going to slowly tick their way down. I want to get like a 5-year loan, 30-year amortized due in 5. I ride that out for 5 years. Interest rates hopefully have dropped, and then what I'm going to do is jump in. One other thing to consider. On your own house, I tend to be very conservative, and so I look at a payment amount, and if I can afford that payment under a fixed rate program, I get a fixed rate loan whether or not interest rates are going up or down. If I lock in my interest rate and interest rates fall, I can always refinance into another fixed rate program. Yes, it might cost me a couple points. Maybe I didn't make the perfect decision, but I think that's much, much different than my investments. I am much more aggressive with the loans and interest rates on my condos than I am my house. Because if things go awry and I lose one of my condos because of switches in interest rates and because someone moved out or someone's in there and not paying and I have to give that condo back to the bank, that's a real bummer. I'm not very happy about it. I probably lost a lot of money, but I am not uprooting my family, taking them out of our house, selling our house, or losing our house and have to go find another place to live. So when it comes to loans on your home, get fixed rates and be incredibly conservative. Two other things that are talked about in this chapter. One is online banking. I like online banking. If you do online banking, Do online banking with some bank you've heard of. Or if you haven't heard of them, you know somebody like your aunt, uncle, mom who deals in the financial industry who's heard of that bank. Like a lot of people haven't heard of ING, which is a pure online bank and a fantastic bank. But you've heard of Bank of America, Wells Fargo, you know they're huge, Chase. There's certainly some other smaller banks. I would not do online banking with some small little bank that you didn't know too much of, that only had 5 or 6 branches. I think the risk there is too great. The risk is a lot less going through, say, Wells Fargo or Bank of America, because the volume of systems and checks and balances they have are huge. And to be able to go in and then talk to the branch manager to find out what's going on with this thing, or a regional manager, easy to figure out. Online banking is getting much, much faster, much, much more secure. But like anything, there's problems. And a lot of people think, well, I don't want to do online banking. I just want to do checks because that's safer. Well, you know, identity thieves started with the U.S. mail. If you mail a check, think of what's on that check. Your signature's on that check. Your name is on that check. Maybe you put your middle initial. Maybe you put your driver's license on your check. If your driver's license is on your check, you should take it off. A lot of people put their driver's licenses on their check back 20, 30 years ago when everybody had to show driver's licenses all the time, and so that became a common practice. Some people, for some unknown reason, even put their Social Security number on their checks. Horrible idea. But also on your check, it has your bank routing number and your bank account. And so if you think mailing a check is a lot safer, if an identity thief gets a hold of a raw check, they've got your name, they got where you bank, they got your routing number, they got your signature, they have your bank account number, and there's really only 2 last pieces they need to do. One, they can go online, look at birth records, and get your mother's maiden name. Not very hard at all. They can probably just look you up on Facebook and get that practically. The other last thing that you should never give out almost anywhere, which would be the last little piece, would be the last 4 digits of your Social Security number. If they also could grab that, they basically have all the keys to take over your finances. I was just recently in Vegas, and I signed up for a player card in Vegas because you got 2 free buffets and a few other things. And they ask questions like, you know, my name, where do I live, what's my email address, so they can send me deals and stuff like that. And then they asked me my Social Security number. And I went, I'm not giving you my Social Security number. Well, that's one of the fields that they ask us to input. Going, yeah, no, I don't want your player card. And the lady looks at me and says, well, that's fine. It's not required. And she goes on. And then at the end, I asked, how many people give you their Social Security number? And she kind of smiled and goes, well, probably about half. And I'm thinking, that is silly, that half of the people prompted by someone standing at a counter who has all their information would also turn over their Social Security number. Very bad idea. You guard your Social Security number as much as you can. In fact, if someone from your bank calls you and says, we're doing a check on your account, and they start talking to you, is this your account number that ends in this? We have your address as this. Maybe all they have is a copy of a check you sent. And they looked up and got your phone number. And then they're going to say, can you please verify your Social Security number? And if you give them that, you're in trouble. Almost any financial institution will never ask you that information over the phone. They also won't ask it in some phishing email that says, we need to reauthorize your account or something like that. But if you get a phone call, and I've done this a number of times from my bank and from other banks, it's like, okay, you're at the Wells Fargo in Glendora on Foothill. Okay, I will call you back. I will hang them up. I will then look up on my phone, and I will Google that bank and where they are, get that phone number, call that phone number, and then get connected back to that person and find out if they're a real person within that branch. In today's day and age, we can no longer give people the benefit of the doubt. It sounds bad. It's against what our mom and dads kind of always said. Well, you got to give them the benefit of the doubt. Boy, with the amount of online scams, we can no longer give people the benefit of the doubt like that. You have to protect yourself, and you have to protect your Social Security number. All right, the last thing I like to say is the difference between a debit card and your charge card. Debit cards now a lot of times have the Visa logo. You can go and use them the exact same way as a charge card. However, instead of the money going onto the account and you pay it off at the end of the month, it's swiped out of your checking account right now. Some people love that, and the reason they love it is because they can set things up, have everything charged to that, and they don't have to worry about a big Visa bill at the end of the month. That's fine. If that works for you, it works for you. A couple things that I do also. You can get an awful lot of things automatically billed. To one of my charge cards, to my Costco American Express, because I get money back from Costco. I have my phone billed to that. I have my water, my electricity, my gardening is billed to that. A number of things are billed to that. It is much, much better if you're going to do stuff on automatic bill payment, instead of having it hit your checking account, have it go to a credit card first. Because if there's a mistake made, if your credit card gets billed for $2,800 because your cell phone provider messed something up, then you're fighting and protesting the money of the credit card company. If you have that billed to your debit card and they hit it for $2,800 and that gets swept out of the account, you'll find out about it when you start bouncing checks. And now you've got to fight back to get your money back. And so on automatic payments, it is always better to have it sent to a charge card. Also, the worst offenders of billing you and not stopping are gyms. If you've got 24-hour fitness or another gym and you're paying $39 a month and they give you a few dollar discount to have it sent to a charge card, once everything stops and you try to cancel, those companies just keep billing and billing and billing, and it's a hassle. And a lot of times what you end up having to do is actually shut that credit card down and actually get a new credit card. So there certainly are those concerns. With every great service and convenience, there comes a way that it could be abused. But right now, I think online banking is incredibly secure, especially if you use a bank you've heard of. And debit cards and having bills automatically charged to a credit card is just another way to make your life simpler. All right, thank you for your time, and that's the end of this chapter.